In 2007, a man bet $1 million that a coin flip could outperform some of the smartest investors on Wall Street. Not literally a coin, but close enough. He bet that a simple, boring fund, one that just copied the stock market instead of trying to beat it, would earn more money over 10 years than a hand-picked team of elite hedge fund managers. The kind of managers who charge you 2% of your money every year, plus 20% of your profits. The kind of managers with Ivy League degrees, Bloomberg terminals, and offices 40 floors above Manhattan. His name was Warren Buffett. And by the time that bet ended, the results weren't just embarrassing. They were almost a joke. Here's the part that should bother you. This isn't a story about one lucky bet. It's a pattern that has repeated, decade after decade, across almost every category of professionally managed money. The people paid the most to beat the market usually don't. And if you have a 401k, a pension, or a retirement account sitting somewhere right now, this pattern is quietly deciding how much money you'll actually have when you're 70 years old. Not a crash, not a scandal, just slow, quiet underperformance, compounding in the background of your entire financial life. Let's go back to where this all started. It's about one man who got tired of watching an entire industry lie to itself. By the 1970s, the money management industry had built itself an empire on a single seductive promise: give us your money, and our expertise will beat the market. Wall Street loved this story. It justified everything: the fees, the bonuses, the prestige. Fund managers were treated like modern-day oracles. Magazine covers, television interviews, reputations built on a few good years, like a gambler bragging about last week's winning streak. And investors believed it because the alternative was uncomfortable. The alternative was admitting that maybe nobody could reliably predict the market at all. Enter John Bogle, a somewhat unglamorous, Princeton-educated financial executive who had just been pushed out of his own mutual fund company after a leadership dispute. Bogle had spent years studying something inconvenient: actual fund performance data, and what he found didn't match the mythological most accurate. A professional manager picks stocks, times trades, and charges you handsomely for the effort. We're failing to beat something absurdly simple: the overall market average. Think of it like this. Imagine hiring an elite team of professional chefs, paying them enormous salaries, and trusting them to consistently cook better meals than your average home kitchen. That basic meal? That's the index fund. In 1976, Bogle launched something Wall Street mocked as Bogle's Folly, the first index investment trust. It didn't try to pick winning stocks. It simply bought a small slice of every major company in the market, mirroring an index like the S&P 500. No genius stock picking, no high-priced analysts, no bets on the next big thing. Just the market, exactly as it was, for a fraction of the cost. Critics called it un-American. One competitor said it would guarantee mediocrity. They weren't entirely wrong. It did guarantee mediocrity. It just turned out that mediocrity, repeated consistently over decades, quietly demolished almost everyone trying to be brilliant. So how does an entire industry of extremely intelligent people lose to doing nothing? Let's break down the mechanics, because this is where it gets interesting. Step 1. The fee structure. Actively manage clients' total investment every single year, sometimes more. Index funds often charge a tiny fraction of that, sometimes as low as 0.03%. That sounds small. It isn't. Imagine two friends each invest $10,000, and the market grows at roughly 7% a year for 30 years. One friend pays a 1% yearly fee. The other pays almost nothing. By the end of 30 years, that seemingly tiny 1% difference can quietly erase tens of thousands of dollars in growth, sometimes more than the original investment itself. Because a fee isn't just a one-time cost, it's a permanent tax on your future growth, charged every single year, whether the fund wins or loses. Step 2. The impossible math of beating the market. Here's the uncomfortable truth. Active managers rarely advertise. Collectively, all professional investors are the market. You cannot have a group of people the average. When they're cracked. Activity creates the average. For every manager who beats the market in a given year, another manager somewhere has to underperform it. It's mathematically guaranteed. Add in trading costs and fees, and the majority of active managers are almost destined to fall short over time. Step 3. Survivorship. This is the trick most people never notice. When a fund performs terribly for years, it doesn't stay around to embarrass anyone. It quietly closes or merges into a better performing fund. When you look at top performing funds today, you're only seeing the survivors, the ones that got lucky enough or good enough to still exist. The failures have already been erased from the record. It's like judging a coin-flipping contest only by the people who flipped heads 5 times in a row and ignoring the thousands who didn't. Step 4. The retail panic. Everyday investors, that's regular people, often chase performance. A fund does well for 2 years, gets featured in headlines, and money floods in. Then it reverts to average or underperforms, and investors flee right as prices are low. They buy high, they sell low, not because they're careless, but because the entire industry is built to reward storytelling, not statistics. Now here's where this stops being a history is built to reward storytelling, not statistics. Now here's where this stops being a history lesson. That same psychological pattern is happening right now, inside your own phone. Every time or a friend brags about a stock that tripled, your brain does something ancient and predictable. It mistakes a good story for good evidence. Behavioral economists have a name for this: recency bias, our tendency to believe that whatever just happened will keep happening. It's the same instinct that convinced investors in the 1980s that Japanese stocks could never fall, right before they collapsed for over a decade. The pattern isn't really about funds. It's about how humans process uncertainty. We crave a narrative, a genius, a system, a reason things will keep going up. Index investing by design refuses to give you one, and that discomfort, the idea that nobody fully controls the outcome, is exactly why so many people still avoid the strategy that has quietly outperformed most professionals for decades. If patterns like this, the psychology hiding underneath financial history, are the kind of thing that fascinates you, this channel exists entirely to dig them up. Subscribing costs nothing, and it means the next hidden pattern lands in front of you the moment it's published. Now, back to that bet. By 2008, Buffett's simple, low-cost index fund was up modestly. Meanwhile, the hedge fund side, the hand-picked, professionally managed basket, was actually losing money, partly due to the financial crisis and partly due to their own high fees compounding against them. Over the next semol, the gap didn't close, it widened. By the time the bet ended in 2017, the index fund had grown by roughly 85%. The average hedge fund selection? Around 22%. Not a rounding error, not a bad year. A decade-long gap, driven mostly by fees and the simple mathematical improbability of consistently beating the market. The proceeds from that bet, around $2.2 million, went to charity, exactly as Buffett had promised from the start. Here's the collapse this created, not of a market, but of an entire mythology. Study after study, most notably an ongoing research report known as the SPIVA scorecard, has tracked this same pattern globally for over 20 years. Year after year, the majority of actively managed funds, often somewhere between 60 and 90%, depending on the category and time frame, fail to beat their basic index benchmark. Not because these managers are incompetent, many are in time frame, fail to manage. My quick manicarg, brilliant. But brilliance isn't enough to consistently overcome high fees, market efficiency, and the sheer mathematics of average returns. Trillions of dollars have shifted as a result. Vanguard, the company Bogle built specifically without traditional shareholders demanding profit so the savings could pass to investors instead, now oversees several $1 trillion in assets. Index and passive investing, once mocked as un-American, now represents a massive share of the entire market. The takeaway isn't that expertise is worthless. It's that certainty is expensive, and the financial industry has spent a century selling certainty it was never able to guarantee. The real lesson echoing through decades of data isn't about stock picking at all. It's about humility, about recognizing that consistency, discipline, and low cost, unglamorous as they sound, have quietly defeated genius, prestige, and charisma again and again. History doesn't always repeat with a crash and a headline. Sometimes it repeats in silence, in the small print of a quarterly statement nobody reads. But not every financial story ends quietly. Some end in absolute, spectacular collapse, the kind where confidence turns to panic within days and empires built on borrowed money vanish overnight.